Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brett Nelson, head of tactical asset allocation with Goldman Sachs Investment Strategy Group. It's so great to have you with us, Brett. Welcome to Trade Talks.
Great. Thanks for having me, Jill.
You got it. And clients are focused on recession risk. What are the arguments for and against the likelihood of a recession?
Yeah, so there's no question that we're facing a lot of uncertainty this year. In fact, we entitled our outlook Heavy Fog to kind of acknowledge that fact. And one of the main ones is obviously around whether we're going to have a recession. So we think that the arguments for a recession and against a recession are kind of equally balanced. And so we've put about even odds on having one this year. Now, on the positive side of the ledger, in terms of what could cause a recession, we know that the Fed has undertaken a very rapid hiking cycle, about 400 basis points last year. And typically when they've hiked that fast, you've had recessions. We see that in a very dramatic tightening in financial conditions with weaker equities, higher dollar, higher interest rates. And then similarly, very widespread yield curve inversions. And so essentially the bond market's telling us that the Fed's going to have to cut rates in the future because growth is going to slow too much. Now, if it were just that, we would say a recession is highly likely, but we also know that there are some countervailing forces. So when we look at the broad US economy, it's pretty balanced. You look at the health of consumer balance sheets, in pretty good shape. There was an interesting statistic out from Bank of America. They said that in the pre-pandemic period, most checking accounts or deposit accounts had about $2,000 to $5,000 in them. Now that average is around $12,000. So consumers are in pretty good shape. And then lastly, we would say that essentially, a lot of that financial conditions tightening that we've seen, the growth impact of that, as well as from fiscal stimulus fading, has actually already hit the economy. And therefore, as we move through this year, that should abate. So our main punchline for clients is that given that we don't have a strong view on a recession or not, we think the odds are about 50-50. We don't think that they should position exclusively for either of those two outcomes. And therefore, we think that they should stick with their strategic asset allocation, which has a mix of bonds, stocks, and alternatives.
So how about ex-US? Are there regions that provide better opportunities than others in developed markets? And also, what about emerging markets?
Yeah, so we've gotten a lot of questions on this. Obviously, these are areas that have lagged the US for many years, and part of that was because they had a much lower technology weighting. Now, obviously, with interest rates rising last year, what we saw is technology stocks dramatically underperformed, and as a result of that, you've seen some outperformance in these non-US markets, and that's continued year to date. When we look at our forecast for this year, however, we see pretty similar returns across these markets, and in fact, we think that that lack of technology exposure, given how much technology stocks have underperformed, as well as the overweighting of cyclical sectors like materials and energy, et cetera, could actually weigh on these markets if we were to see a recession. And then lastly, we know that these markets have been helped by the fact that the dollar has been depreciating in the past few months, and that's particularly been helpful to emerging markets. But as we think about our forecast going forward from here, and given that the dollar is now very oversold, we would say that that also could present a risk. So given we're not seeing huge return differences between the US and these non-US markets, we're not advising our clients to be significantly overweight or underweight these areas.
You know, it's interesting, Brett, the narrative in the market has been for nearly a decade that the 60-40 model portfolio is dead. But I hear a lot of balance in the narrative here that you're discussing. Is 60-40 still a good starting point then for building diversified portfolios?
We think so, and we think that some of that narrative that you're talking about of 60-40 is dead is definitely overplayed. So where is that coming from? Well, last year, obviously, 60-40 portfolios were down, which isn't that rare. One of the key statistics, or one of the key things we think about in our investment philosophy is history is a useful guide. And historically, at least about 20% of the time, you've seen these 60-40 portfolios lose money. So in and of itself, that's not that rare. But what was rare about last year is that you had both stocks and bonds down, and that only happens about 2% of the time historically. Now, people on that basis say, let's get out of 60-40s, but we think a couple counterpoints are important to keep in mind. The first is that when you had those rare periods of stocks and bonds being down that only happened 2% of the time, in the subsequent 1 year and 2 years, you actually have well above average returns. And I think the statistic is something like over a 30% return for that portfolio over a 2-year period after those rare downturns. And then secondly, when we think about the 60-40 portfolio, it's tended to recover pretty quickly. on average, it's been about 8 to 10 months to recover the drawdowns after past years when it had losses. So given that fact, and given these relatively quick recoveries, the above average returns, we do not think that clients should be abandoning a 60-40 portfolio or a simple mix of stocks and bonds as a starting point for their strategic asset allocation.
Right, Brett, and that was exactly my question to wrap up to you here is how is, Goldman Sachs advising its clients when it comes to asset allocation? It really feels like 2023, and even looking forward as we come back to more a normalized market, if you will, versus just markets that were going from the bottom left of the screen to the top of the right, that asset allocation is going to be more important than it has been certainly in the past couple of years.
Yeah, I think that's exactly right, and very consistent with the way we're thinking about the world. In an environment when you have 50-50 odds of a recession and lots of uncertainty, we think that that's not the time to be positioning exclusively for one of those outcomes or the other, or taking big deviations from your strategic portfolio. And therefore, that's the advice we're giving clients. Stay close to home. We do think that there are more paths to positive equity returns than the odds we're placing on recession, because at the end of the day, equities are forward looking. They tend to bottom before earnings trough, and markets bottom on bad news. So we're somewhat optimistic, but we nonetheless, acknowledge all of the uncertainties and are recommending that clients stick with their strategic allocation and stay invested.
All right. We appreciate the insight, Brett. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.